Welcome to today's explainer on the devaluation of the dollar. We're going to dive right in because, look, we are dealing with an invisible force that is constantly at work in the background of our global economy. It might not make the front page every single day, but it's quietly, persistently shrinking the value of the fiat currency sitting in your bank accounts right now. Just consider this for a second. A single US dollar back in 1913 had the exact same purchasing power as about $30 today. 30! That is a massive erosion of value over a century. So today, we're unpacking the devaluation of the dollar and the broader macroeconomic mechanics of global inflation. If you want to really understand these systemic forces that are draining your hard-earned cash, you're in the right place. I want you to just think back a few years. Have you noticed that everyday items, whether you're grabbing a quick burger, upgrading your smartphone, or just picking up your morning coffee, they simply demand a lot more of your capital than they used to? The price tags on consumer goods just mysteriously creep upward, and they rarely ever return to their previous baseline. So why exactly does this happen? Well, the answer is inflation, but it's not just some magical price hike. In this explainer, we're going to break down the exact mechanics behind these shifts, investigating the actual levers that move global markets and why this hidden tax affects absolutely every single one of us.
Section 1. What is inflation? Let's do a really quick recap of the basics.
At its core, inflation is just the general increase in the prices of goods and services over time. But to truly grasp the economic impact here, we have to look at what happens to the currency itself as those prices rise. You see, as the cost of goods goes up, the actual intrinsic value of your money goes down. We call this purchasing power decay. It essentially means that the exact same amount of capital you hold today buys a fraction of what it did previously. The physical items on the shelves, they aren't fundamentally changing, right? Rather, your currency is steadily losing its muscle, its capability to actually acquire them.
Let's look at it this way. Say a standard loaf of bread cost you exactly $2 last year. You walk into the grocery store today, and that exact same loaf is $2.20. Math is simple, sure, but the implication of that 20-cent jump is pretty profound. That is inflation in action. Your $2 bill used to be enough to totally clear the transaction, and now it falls short. And think about the compounding nature of this whole thing. If you extrapolate that seemingly small 10% jump over a decade, suddenly that staple item costs you over $5. When applied across every good and service in an economy, this purchasing power decay transforms from, a minor annoyance into a severe systemic drain on your overall wealth.
Moving on to Section 2, the three suspects. Let's look at what actually causes this.
There really isn't just one single reason why inflation happens. It's usually a pretty complex combination of macroeconomic forces. But we can round up the usual suspects into three main categories. We've got high demand, higher production costs, and more money circulating in the economy. Now, rarely do these forces act in complete isolation. More often than not, they kind of create this tangled web of economic pressure, feeding off of one another to push the baseline cost of living ever higher. Let's break each of these down so you can see exactly how they pull the strings on the global economy.
First up is what economists refer to as demand pull inflation. This happens when high demand aggressively pulls prices upward. Imagine a scenario where a massive surge of consumers suddenly wants to buy the exact same product, but the supply chain is completely fixed or limited. A really perfect recent example of this was the post-pandemic revenge travel boom, right? After months of lockdowns, demand for flights absolutely skyrocketed. But airlines had limited planes, limited staff, and a fixed number of routes. Because travelers were so aggressively competing for those few seats, airlines realized they could massively increase their prices and people would still happily pay. The demand completely outpaced the supply, pulling the price tag right up along with it.
Our second suspect is cost-push inflation. Now, this dynamic doesn't start with you, the consumer, at the checkout line. It actually originates with the manufacturer on the supply side. If a company suddenly faces much higher costs for the raw materials needed to make their product, or if global supply chain bottlenecks and energy crises make transportation vastly more expensive, well, their overall costs of production spikes. Think about recent years where semiconductor shortages or huge fuel spikes drastically increased manufacturing overhead. Companies aren't charities. They rarely just absorb those margin hits. Instead, what do? They protect their profit margins by pushing those extra costs directly onto you, the consumer, by aggressively raising the final retail price of the product.
And that builds perfectly into our third suspect, more money in the economy. Now, at first glance, injecting more money into a system sounds pretty fantastic, right? But in monetary policy, there's a classic phrase for this: too much money chasing too few goods. When central banks engage in quantitative easing or governments distribute massive stimulus measures, the total money supply swells.
If consumers are suddenly armed with this huge influx of cash and they're ready to spend, but the physical economy literally cannot produce goods quickly enough to meet that massive wave of new demand, the outcome is mathematically inevitable. Prices rise. The inflated money supply dilutes the value of the currency, driving the nominal cost of literally everything upward.
Section 3. The paradox. Is inflation always a bad thing?
You might naturally assume that inflation is the ultimate villain of finance, but macroeconomics is rarely that black and white. A small, highly controlled and steady amount of inflation, which is exactly why most central banks target a rate of around 2%, is actually considered incredibly healthy. It acts as an economic engine. It encourages individuals and corporations to spend and invest their capital right now rather than hoarding it in a vault somewhere, precisely because they know purchasing power will be slightly weaker tomorrow. It keeps capital flowing, and crucially, it helps avoid the dreaded alternative, deflation, where stalled spending totally collapses an economy. However, as we well know, very high inflation creates immediate crises. A rapid loss of purchasing power devalues carefully built savings, it creates terrifying uncertainty for business planning, and it just makes daily survival overwhelmingly expensive.
Section 4. Fighting back. Let's look at the role of central banks.
When high inflation threatens to completely destabilize an economy, most nations rely on their central bank to step in as sort of the financial police. Their primary mandate is to keep inflation tightly controlled, and the main tool they use to do this is the federal interest rate. Let's walk through this engineered cooling process step by step. First, the central bank increases baseline interest rates. Consequently, borrowing money, whether it's an everyday consumer getting a mortgage or a massive corporation securing a credit line for expansion, suddenly becomes aggressively more expensive. Because capital is so costly, businesses and individuals borrow less and they spend less. Demand falls across the board. Eventually, because spending dries up, businesses can no longer hike prices without losing their remaining customers, and inflation slows. But it is absolutely vital to note the lag effect here. Raising rates is kind of like turning a massive cargo ship. It often takes months, sometimes over a year, for this expensive borrowing to actually permeate the system and cool down the broader economy.
Section 5. The impact on your wallet.
Let's bring this macro theory right down to the micro level, because inflation affects absolutely everyone. The everyday reality is harsh, right? Grocery bills swell, landlords increase rent to match the market, and fuel prices at the pump surge. But honestly, the most insidious aspect of all this is the concept of the stealth pay cut. Think about it. If you're earning a fixed salary and that salary stays exactly the same year over year while inflation is running at 4 or 5%, your compensation is functionally shrinking. You are taking a hidden tax on your labor. Even without your boss touching your paycheck, your income simply buys fewer goods, meaning you are technically earning less in real-world purchasing power.
And that brings us to the core of why we are doing this explainer today. How you can actually make smarter financial decisions to fight back and protect your personal savings. Inflation is a baked-in feature of the global economy, meaning you absolutely cannot afford to be a passive observer. Recognizing this invisible force is step 1. Step 2 is actively deploying financial strategies against these rising costs. Savvy investors combat purchasing power decay by strategically allocating their funds into assets that traditionally outpace inflation. This could mean building a nicely diversified portfolio of equities or exploring real estate, which often acts as a really robust inflation hedge. You can also utilize specific government bonds, like Treasury inflation-protected securities, commonly known as TIPS. Even on a much simpler, day-to-day level, it means ensuring your liquid cash reserves are sitting in high-yield savings accounts that actually offer a competitive interest rate, rather than just letting it rot away in a stagnant zero-interest checking account. You literally have to ensure your capital is working just as hard as you are.
Which leaves us with this final essential question. As prices inevitably rise and the economic tides shift around us, is your money just sitting idle, or is it strategically deployed to outpace the invisible tax of inflation? Understanding the mechanics behind the devaluation of the dollar isn't just some academic exercise. It is a direct call to action to protect your purchasing power. Don't let your finances quietly shrink while you're not looking. Thank you so much for joining me for this explainer. Keep this question at the absolute forefront of your strategy. Stay curious and keep making those smart financial choices.